Welcome to Outlier University, where we help you save time, make money, and start winning with less risk. Go ahead and subscribe if you haven't already. Week 7, the biggest mistakes when trading options and trading in general, really. Week 1, we went over the foundations. Week 2, developing or thinking like a successful trader. Week 3 was developing your trading plan. 4 was sharing your results. 5, managing money like a pro. 6, the bestest way to trade is with options. Today, we're going to be talking about the biggest mistakes when trading options. I will not hit the mute button this time. And we're going to be talking about rolling part 2, and we will show you definitively, conclusively that rolling is the greatest ninja hack of all time, period, full stop. There is no doubt about it. Consider rolling a de-risking move. The objective when we're rolling is not to make more monies. The objective when we're rolling here is to take risk off the table. The number one sole purpose, without any doubt whatsoever, is to remove risk. What did I say earlier? Did I say, let's count our Lambos together? Let's count our Lambo-shaped pools together. Let's just talk about how much money we're going to make. No. Less risk, my friends. This is one of our core tenets, core principles. If you want to be successful in trading, you have to trade with the least amount of risk. This is a de-risking move. Now let's look at real trades to see why this is so important. I've gotten so fancy that I made it a workbook link, so I can just click it. You have to hit Control click. And dadgum. All right, so fancy that I don't know what I'm doing here. Control click. There we go. Professional YouTuber at work, folks. There we go. Let's look at some numbers. I love numbers. I'm a numbers guy. So on the top up here is the 4 option trades, that I have on at this very moment. Now, KGC, PPTA, NEM, and OR. This is how much I paid for them when I originally bought these options. Now, you can have access to exactly this by going to the description down below. You will see exactly this workbook right here. And you will see exactly these trades that we're going to talk about right here. No excuse. So this is how much it cost me to get into these, okay? Now, we're not doing contract sizing or anything like that. We're only focusing on as if these were one lots. Now, how much credit have we taken in from these trades? Absolutely nothing. Clearly nothing, because we purchased them. So therefore, we can't do anything with them, right? So we have purchased them, nothing to do. And this is what the price today would be, that if I were to sell it, I would get back as a credit. So in this case, this trade has gone up 67% from entry. That's pretty awesome. Super sick. This one has gone up 12% from entry. Not as good, but still, profits are profits. I'll take it. This one has gone up 108% since entry. Man, what a great trade. This one, 43% from entry. Outstanding, right? The average profits, 57%. That's not normal, okay? These are the trades I have on right now. Having your average trades be 57% is not normal at all. But 100% of this dollars that I bought is at risk. What do I mean by that? If something were to happen on these stocks, every penny that I paid for this is still at risk. My paper profits are here, but I have absolutely all of the risk of this original trade on still. Now, let's say that we rolled, which I did. Price at entry is going to be the exact same as above. See if I can make it fit a little bit better. Price at entry is the exact same as it was above. These are the strikes that I rolled to. Some of them have taken 1, 2, or maybe even 3 rolls. And in that, this is how much credit I've taken in during that time. So for this one here, I've taken in $387 of credit when I paid $350 up front for the trade, right? Which means that this trade is actually risk-free. I have an 11% gain that is locked in permanently that can never be taken from me whatsoever. But Chris, that's a lot less than 67%. Yeah, I know. I'm okay with that because I've given up all of my risk. All of my risk. Now, not only is it the credit that I've taken in through these rolls, but it's also the price to close it today. I get both of these back. I've already got this banked in my account. And then if I sell to close, this is how much credit I get. Pretty cool, right? Which means my profit in this trade is 63%. Is it less than 67? Yes. That is basically the amount of deltas we've given up to roll from the 30 strike to the 35 strike. Is giving up 4% on this trade on profits. But you know what I have done? I've eliminated 100% of the risk to the point where I have guaranteed profits. Let's continue on. How about PPTA? The price today plus the credits I've taken in means that the profit is at 11%. Oh, that's less than 12. I agree. But you know what's also awesome about this? This is like 1% different here. Yet I've taken off 73% of the risk. There's only 27% of the risk left. And I've given up 1% of my gains. This is pretty sick, right? You guys liking this? Give me a thumbs up if this is making sense. Give me a thumbs up in the chat if this is making sense too. You go to NEM, right? 108% gains on this. That's pretty outstanding. You're right. It is better than 98% gains. But I only have 6% of the risk in the trade left. 6%. I have basically no risk in the trade left. Almost zero. And then lastly, or 43% gain. Oh, you know what? I'll take 2% less risk. 2% less profit for 50% less risk. 50% less risk. So yes, I am giving up profit. I'm giving up 4% of profit for having 81% less risk. Let's conceptualize this here. I'm trading 4 pennies off of my profits to get back 81 pennies back, if you want to think of it that way, in risk. I feel like that's a very fair trade, an exceptionally fair trade. In fact, if we come over here, the return to risk, these still have 100% of their risk. And I've made 57% on profits, okay? 57% returns. Return to risk, 57%. Hold my beer. These have 53% profits, yet 18% of the risk on average, 18% of the risk that these have, which means my return to risk is 293% versus 57%. That right there is one of the coolest things I've ever come across. And so I kind of got inspired by Rick talking about the leverage factor on these trades, because you are upping the amount of leverage you have by decreasing the amount of cost in the trade. So our return to risk in this case, 296%, or 4% less in total gains with 81% less risk. But you know what? Maybe you want to see this in a chart. Okay. Maybe you just don't believe this random guy on the internet. How about this? Let's move you guys over here. How about this, right? Yes, we are giving up a itty bitty baby bit of our profits by rolling. But look at this absolute dominance and how much risk we've taken off. All the risk, negative risk. So yes, I will concede and say you're giving up deltas. But I am not in any way, shape, or form saying that holding the original trade is better than not rolling. In fact, I would say quite the opposite. I would say you are giving up so much of your portfolio by holding on to the original trades, because it gets even better. All of that cash I can do anything else with. All of that cash I can now deploy into new investments. So I'll give up 4% here to go make another 40% somewhere else. Ooh, Chris just dropped the mic. I'll give up the 4% across 4 different trades to go make 98% on another trade. If anybody has any way to say that this is not the right way to trade, by all means, let me know. But you're wrong. So if you want to not roll, by all means do it. I don't care. But I'll roll. I'll reduce my risk. I will make the return to risk just grow exponentially. And then I'll have so much money left over. I'll go buy 4 more trades and do it over again. There you go. Is that conclusive enough? Does everybody get it? Everybody got it? Cool. We're going to move on. And if anybody ever doubts the power of rolling, we need to make sure that they are aware of why the math works. Why the math works. All right, let's get back over to this. So, of course, consider it a de-risking move. That is the plan. We are de-risking. And by de-risking, all the good stuff happens. All the good stuff happens. All right, let's keep going. Biggest mistake here, holding on to losers for too long. Now is where I'm going to start quizzing you guys. Charlotte, you're first up on the board. Why would you feel that holding on to losers for too long is one of the biggest mistakes?
Oh, well, I'm kind of guilty of this one. So
let me know about it.
SPXL the other day, I stayed in too long and kind of lost some money.
Well, was it accidental or was it intentional? Right? Were you like, you know what? I got my exit signal, but I'm not going to take it anyway. I'm just going to hold on to it.
I do have a rule that when we get the exit signal, I wait 24 hours and then review the trade. And if it's a red candle, you exit immediately. But that combined with suddenly not being able to be at the computer when I thought I would be meant that I stayed in too long. And by the time I got out, I had lost money.
Well, if it's part of your plan, which is what you said it was, then it's not that you held it too long at all. It sounds like you executed the plan. So I can't fault you for that.
It kind of was, except the plan came about because one day I didn't want to get out. So I thought, I'll just rewrite my rules right here and now.
You did what? Hold on a minute. Thank you, Charlotte. We're about to go into psychology session here. I hope you got the couch that you can lay out on. You did what? You were in the trade and you decided to start changing the rules of the trade in the midst of the trade?
Yeah.
Okay. Why?
Because it seemed to fit.
Fit in what do you mean by it seemed to fit?
It did seem to work, and it has been quite a good scheme. So
okay.
So I had been watching when I came out of the plan ETF. I've been watching and noticed that when the one I do, which is slightly different to yours, that the next day it was coming back in again. So I had noticed that it was tracking that way, but it was during the trade that I thought, you know what, I'm going to change my plan. So I know that was wrong.
That's a dangerous game to play. Super dangerous game to play.
And then being rewarded for changing it too, that's dangerous as well.
Exactly. Because whenever you make changes, and this happens to a lot of new traders, so don't feel like you've done anything wrong in that regard. Whatever you're making changes to the plan, you want to do it when you have absolutely no money in the market. You have absolutely no emotions tied up with that money, right? And I'm not saying you're emotionally charged with it. What I'm saying is that you do have some sort of connection to the outcome of the result. So changing the plan mid-trade feels good. Oh, you know what? I've seen this a couple times. I think that this is going to happen a third time. But if that is the case, you still need to follow the plan to its end. But then once you're out, that's when you can take a step back and say, okay, I followed my rules. This was the outcome. Now, was this just an unlucky break? We've talked about this the other day. Is this just an unlucky break, or is it a flaw in the plan? That's when you can go back and you can objectively look at it and you can say, okay, based on the plan, based on the previous signals that I've seen, right? Actually, if I hold for one more day, I increase my expectancy, right? I've increased my expectancy. And so therefore it actually is a benefit to the plan to do this. So I'm going to modify the plan in that way.
Right.
So
yeah, I just knew doing it in the trade was the wrong way. So that's why I wasn't letting myself get away with, oh yeah, that's my plan.
Charlotte, listen, it takes a lot, first off, to admit to doing something like this, and also to put it out on the internet. So I want you to know, I really appreciate you sharing that. I want everybody to give Charlotte a golf clap because she very much deserves that. And I did not know that ahead of time to have called on you. But you know, that is a very common mistake, and it is okay because everybody needs to learn in their own way. And Charlotte, I hope that worked, to help you out in one way or another.
Yeah.
Cool. Let's keep going here. A couple things that I wrote down is like with trading, the market's going to tell you if your trade is working or not, right? You just have to listen. you must listen to the market. I've got several slides here that I want to showcase real quick. This super handsome guy, very humble. He probably has more than 40% of hair when that picture was taken. Said, "Today is the day to take the opportunity to turn your small losses back into cash before they become big losses. Don't let this opportunity pass you by." He's probably one of the greatest poets of our generation. Anyways, let's move on. So this came from Minervini, and I love this slide. You guys have definitely seen this before, but you buy and then it just doesn't work, and you actually have fear, right? You actually have fear that if you close the trade, it's just going to turn around and go. And that is a super common, absolutely justifiable fear to have. But what will happen is if you stop listening to the market, you're going to get caught in a situation like this. And to Charlotte's point, right? You may get rewarded with a bad habit, with a good outcome on a bad habit more than once, which actually helps reinforce the bad habit. And if that happens, right, it becomes even harder to break yourself of that bad habit. Let's keep going here. So I'm very excited. We're going to be having Mark on here in a couple of weeks. But here's the cold, unforgiving truth. You can take small drawdowns, feel stupid, and still walk away with your capital and your future intact. Or you can hold, hope, and on the rare occasion, you're going to blow up. If you're not feeling like an idiot often, you're not managing risk. So let's see who's next. Who's next in the firing line? Stocky Locky. If you heard somebody say, if you're not feeling like an idiot often, you're not managing risk, what does that mean to you?
If you're not feeling like an idiot often, you're not managing risk at all. Yeah, I guess at the time you probably feel like you're missing out. So you feel like an idiot for cutting your losses. Yeah. But at the time, you think I could, it should go up, so I should stay in. But we all know, obviously, don't stick to your plan, then your trade goes south, and then therefore it's better to feel like an idiot but manage your risk than to not.
No. You're on the right track, dude. I'm not going to stop you. I do want to showcase a couple examples. One is ego, right? Which I was managing risk and I took my trade off here. It ran without me. That's fine. I don't feel like an idiot because I didn't care. It's not part of my trading plan. But also, in the same regard, if I had left it on, hoping and praying that it would continue to work, how about MP? Another trade that we put on and we took off and we made, how much money did we make on MP? Not much, 18%. But it sure is a hell of a lot more than this, right? Huge, big, nasty down moves.
And that's what we're protecting ourselves for.
And that's what we're protecting ourselves from.
Yeah, we want to minimize that risk. And that's been the whole play, if you like.
Right.
The whole reason for having, plan M, ETF plan, it's to minimize the risk and it's to stop this exact reason, this exact thing from happening.
Exactly, dude. Right. And sometimes you're going to feel like an idiot. And the reason I wanted to share those is like, you could, in one way, look at the ego trade and be like, man, I feel like such an idiot that it continued to run without me. Or you followed your plan and you got out. And you certainly don't feel like an idiot when the MP trade comes up and it's down 10% in a row, 2 days in a row. And you're like, okay, well, good thing I got out of that. Right? It is absolutely common to feel like an idiot. Totally common. If you're not feeling like an idiot, you're not managing risk. And that is okay. Don't worry about where the markets or what the markets are going to do. Worry about what you're going to do in response to the markets. So if the market is doing one thing and it's not what you expect and it's not what you want, what is your response to that? If the market is doing what you want and you're making money, what is your response to that? Some people absolutely lose all sense of self-control, all sense of risk, and get into an absolute like nothing can go wrong state if they get a couple winning trades. Same thing can happen for a couple losing trades. They lose all of their control and just are overwhelmed by fear. You got to worry about you in this case. The hardest part of trading is between your ears.
That as well, Chris, is also an element of people trying to predict the markets rather than reacting to the markets, which again is another fundamental layer that we follow.
Absolutely. Here's another picture, Mark. There is no shame in losing money on a stock trade. Not at all. And I don't know why anybody would feel shame on losing money on a stock trade. But to hold on to a loss and let it get bigger and bigger, or even worse, to buy more, is amateurish and self-destructive. Imagine that you play basketball, right? You go out, you shoot a shot, and you missed. Do you go put your head in the corner? You're like, oh my God, I'm such a loser. No, it just didn't work. So then you come back and you make some adjustments and you try again. And it might work that time. You're like, yes, all right. And then one time you go where you make a half-court shot just on accident. You're like, man, I didn't realize that I had such skill at making half-court shots. And it's the one time out of the next 100 that it worked. And it wasn't skill. It was just absolute luck. You just happened to make it, right? That happens to a lot of people, and they get rewarded on making a bad trade, making a bad shot. Having the consistency in the process is the important part here. So remember, 90, 90, 90. I never want you guys to forget this. Shane, what do I mean by 90, 90, 90?
It's 90% of traders lose 90% of their account in the first 90 days.
Yep. You know what's sick about that? That's normal. That's really, really sick. But you no longer abide by these rules because you guys are outliers. Totally different here, right? Which means you're not normal at all. This stat, I can't make any sort of promises. I can't make any sort of income claims or anything like that. But this shouldn't happen if you're an outlier. For everybody else, it's normal, but not for outliers. Let's keep going. You're not normal in all the right ways. All right. How about gamma risk? All right. Now, who's next in the firing line? Mr. William on vacation, which I appreciate that you're joining us from vacation.
I wouldn't.
What in the wide world of sports to you does gamma risk mean?
So I take gamma risk as increasing your risk as you become deeper in the money, or closer to expiration, I should say. Let me start over. Sorry. So as you get closer to expiration, your deltas will increase because there's less time for the stock to move prior to expiration. So one of the things that we do is we can roll out or we can roll up, and that will help to decrease some of our gamma risk. Even if it costs us a couple % potential gains, we're protecting ourselves on the downside by doing that.
Yeah. Okay. I like it. That's a really, really solid answer. Dude, every time I hear gamma risk, I think of like the Hulk and Spider-Man battling each other in a lab surrounded by like just test tubes of like oozy, like highlighter blue goo, right? And they're knocking it over and like things are spraying out everywhere. Like that's what I think of when I hear gamma risk, right? Not necessarily the case in trading though. ChatGPT describes it as gamma risk in options refers to the risk that an option's delta changes rapidly as the underlying price moves, especially when the option is near expiration and near the money. Okay. So William's right on the money. Like he's totally nailing it right here. Okay. The closer you get to expiration, the more and more likely we will see a stock fall in or out of the money. Let's talk about this, right? If this stock expires tomorrow, KGC expires tomorrow, the 36 strike will determine if the value of the option has anything or
it's all there, black and white, clear as crystal. You get nothing. You lose. Good day, sir.
And the closer we get to expiration, the faster we will find out if it will be higher than $36 or less than $36, right? Because we've accelerated how fast the deltas will move. By expiration, we talked about this last time. By expiration, all of these will either be 100 or 0. So your gamma has to expand going from one to the next, because the further out you go, hey, you know what? Gamma's not doing all that much. In fact, hold on. There is a gamma setting on here. I turned it on the other day and I was like, oh, that's kind of cool. Let me turn it back on real quick and we can talk about that. Option grid. And let's add gamma. Exit. Where's I got to save it. Professional YouTuber at work. Hold on. Option grid, Yule, gamma over, then save it. Now it's there. Look at that. Like I knew what I was doing. Okay. So look at these gammas. This is all kinds of gamma radiation over here. 20 gammas. 20 gammas. Versus you go out, let's say 43 days. This is the 3550 strike. Let's go to the 35 strike. It's probably going to be there. 18 gammas versus the 35 strike of 5 gammas. That's huge. Remember, gamma is the change between deltas. Okay? So the higher this goes, the more your money, or more likelihood, let me rephrase that. The higher this goes, the closer this is to the money at expiration. And we want to remove that as much as possible. So with gamma risk, your investment can be worth literally nothing if you let it expire out of the money. I don't want that. You don't want that. I don't want literally nothing to be my investment. And the moves are heightened closer to expiration. So just remove the risk completely. Just don't have it. Remove the risk entirely by rolling out in time within a week of expiration. Now, does it have to be exactly 7 days? No, of course not. If you want to do like 12 days, then roll it out. Sure, why not? But if you're getting down to like 3 or 4 days, you better be figuring out a plan to either get out of that trade or move it out in time, because your time is about to run up. Trading illiquid options. All right, who's next? Who's next? That'll be Mr. Shane. Shane, you're next. What does it mean? Wait a minute. Did I call on you, Shane, already?
Yeah, but I'll go again.
No. You're not going to take Art's turn. It's Art's turn. Sorry. Art, I'm sorry. It's your turn, my friend. What does it mean? One of the biggest mistakes is trading illiquid options.
You should be sorry, man.
Ah.
I've never heard that before, liquid options, but I'll take a guess at it that there's no liquidity in your trade, and if there's no liquidity, you're not going to be able to get in and out of the trade.
You've never heard the term illiquidity?
No.
You must not be a finance bro like me.
No, all I care about is delta. 80 delta. I don't need no gamma. I don't need no nothing. All I need is 80 delta.
I know what you need. We need to get Art a chain that just says delta. That's all he wants. He just wants the deltas.
All I care about is delta.
He just wants the deltas. I want the deltas too. But Art, you can't have any deltas if you can't get in or out. Exactly what you said. You get no deltas. You get negative deltas in that case. Now, I have heard some horror stories of penny stocks, especially penny stocks, because these people get this idea that this penny stock is going to be the next thing, or at least somebody convinced them of that. They go out and they buy 10,000 shares of this penny stock. No issue getting it. But when they go to sell those 10,000 shares, guess how many people are looking to buy? Nobody. Literally nobody. Not a soul on planet Earth is willing to buy those shares. So first, you want to look at open interest, because this will tell you exactly how many people, how many contracts are ready to be traded. These are orders waiting and sitting. I got to move this. You got to move this. Let's make a deal. Right. And if you can't get in or you can't get out, you just get whatever the market gives to you with no recourse. Right. If the stock falls 100%, 20%, 5%, it means nothing to you because you're cooked. You can do nothing about it. You are absolutely just along for the ride. I don't want that for you, right? And options have significantly less liquidity than stocks, right? A lot of the stocks I like to trade on in Outlier, I even filter it for 1 million average daily shares. Do you think there's 1 million average daily options traded on every single strike? No, of course not. Of course not, right? There can be thousands. There can be hundreds. And in this case, right, when you see this, zeros and ones, that means that these are new strikes. So they just haven't had anybody looking at them yet. That actually doesn't scare me. If it has liquidity on both sides, but I want that one in between, I'm fine. I know I'm going to get filled, no issues. But let's go to SoFi. the greatest stock in the history of time. The greatest stock ever known to man. Let's go to one of these strikes over here, right? Like over here. There's nobody there to trade with. There's really not. The only strike that has any sort of liquidity is the 20 strike right here. Elsewise, I would not be trading this. But SoFi is a super popular stock. Millions of shares are traded daily on SoFi. Your rule of thumb is you need 4 to 6x as many contracts in open interest as you're looking to trade at a minimum. You can use a round number like 250. You can use a round number like 1,000, whatever, right? And holding this true, 50 may be plenty, right? 50 may be plenty. If you're trading small lots, and there's no problem with that. If you're trading small lots, if you have like one contract you're looking to trade and you see 18 open interest, that's 18 times as many as you need. Could be fine. Could be totally fine. But once you start getting up in size, you need to be able to make sure you can get in and get out.
So Chris, one of the things I noticed on the third Friday of every month is something I've known, but I really start looking at is that liquidity on that third Friday is always much greater. And then the other thing was, as outliers, when we all get into one stock, we make the liquidity, and that number will go up the next day quite a bit. And I know Dave was working on that. David was working on those numbers. But yeah, so liquidity is important, but I think we can make the there's a great example of on the 20th, right? Look at all that liquidity.
Right. Well, first, you're 100% right. You do have different expirations, right? So let's see. Here, you can see all these expirations. But if I come up here, I think we can change the expirations to be regular. Regular means monthlies. So if I click this, you'll see a lot less right here. It's the third Friday. The third Friday of the month is the, quote, regular normal expiration. They have added more expirations to lots of stocks. Not all of them, but lots of stocks, because that gives more opportunities for people to trade and have it fit their trading plan, right? But also, they have added more to things like Meta. Now it's 3 days a week. And I think they did that for degeneracy, right? People who are literal degenerate gamblers with the 0 DTE options are like, well, now I can trade this 3 times a week instead of just on Fridays. That is the fastest way to blow up. Well, I always say like all kinds of different ways are the fastest way to blow up your account, but it's a great way to blow up your account. I'll put it that way. Trading 0 DTE options. Remember the gamma risk? Let's look at the gamma risk of this one here. The 730 strike on Meta. Let's look at it that expires tomorrow. So the gamma risk is 68. Let's call it 68 cents. Gamma risk on the 730 that expires tomorrow is $2 and change. So it's like 2.5, 3 times as much gamma risk within the span of just a couple days. I don't even remember which strike we were on or which expiration. But the point is that as you get closer to expiration, remember, all of these will be 100. All of these will be 0. And we don't want to have it be 0. We don't want it to have it to be 0. So you want to make sure you have all liquidity that you possibly can. And to Art's point, the third Friday of each month is regular expiration. And that is where the majority of investors will go. But you do have the opportunity to trade basically any of those as long as it fits your plan.
So I think I've changed my plan up a little bit.
Okay.
So not always 21 days. Because if I can't find the liquidity, I'll go to that third Friday. And maybe I'm out 35, 40 days. So I'm always looking for all that liquidity. And if I really want to get into something and everything lines up, I might have to go longer than 21 days to get that liquidity I'm looking for.
And honestly, that's a great plan. I've done that many times, right? I can't find liquidity at 21 days. I'll look a little bit before, a little bit after. But going to the monthly makes total sense, dude. And honestly, if you just went with monthlies, there's nothing wrong with that. The only thing is you'll have to pay more for it because it's further out in time. It will always have more extrinsic value. And just for me, the 21 days has been a sweet spot. There's nothing wrong with going 35 days on a monthly because of liquidity. I think that's a very valid point, dude. How about this mistake? No exit plan. No exit plan. I know a guy who has lots of exit plans, so I'm going to ask him, Why is this a mistake, Mark? Why is having no exit plan a mistake?
It's because you hold on to your losers too long and cut your winners too short. And having no exit plan is basically how I almost blew one of my accounts last year. Before I dialed it. It was that hope that it comes back, just like the graphic that you showed, earlier, that fear of missing out and all that. Like, it didn't have a solid exit plan. It was too it'll come back. I have time, but nothing was clear. It's like, no, I need to get out here and just cut the loss and move on and forget about it. And that's what it is. And that sucks a lot of people in, psychologically, with it. If you don't have that defined rule set, it allows you to go off the reservation. I think one of the things in trading in the zone, it said, it's like one of our advantages is that we have complete freedom to do whatever we want in the market. That's also the biggest drawback, is that we have complete freedom to do whatever we want. And that works against us if we don't have that exit plan in those rules. And that's how we crush ourselves.
Dude, that's one of my favorite quotes in trading in the zone. Is there are unlimited opportunities to make unlimited trades, something like that. But exactly what you're saying, right? There's unlimited ways to make money, but also unlimited ways to lose money. Yeah, well said. Let's keep going here. A professional at anything knows their plan. Let me ask you guys, is somebody okay with sharing what they do for their day job? Just raise your hand if you're cool with it. Shane, yeah. What is your day job?
What I'm doing right now, working as a firefighter or a captain at a fire department.
Dude, he's not just a firefighter. He's a firefighting captain. I love it. Captain Shane over there. All right, so Captain Shane, when there's a fire, do you have a plan to put out that fire?
Oh, God, yeah. We have tons of SOGs and SOPs that guide us along just about any type of emergency you can think of. And it's over years and years of experience and everything. It's a process designed to, show us how to keep people safe and at the same time, mitigate risk.
Okay, Shane, but what if like a really, really pretty girl walks by on the street? Like you're over there, you're just going to town, spraying down the house, and you're like, "Ooh, holy moly, look at that thing!" Are you going to like FOMO into chasing after her?
Yeah, that's part of the SOG is FOMO and just forget about all the training, go run after the hot girl.
Yeah,
no, okay. They're designed so you don't get distracted by a squirrel. Right.
Exactly. Okay. So you wouldn't FOMO into doing something else because you're in the middle of enacting your plan, right? What about, if you saw the fire and you saw how things are going, would you just panic and be like, I can't do anything about it, and just take a step back and be like, y'all have fun, good luck?
No, you gotta stick to the plan.
No. So you wouldn't FOMO into doing something else, and you wouldn't panic into just, I have nothing that I can do about this, right? Like you actually have a plan because you're professional and you're going to make sure you see the plan to its completion, right?
Absolutely.
I wonder if people could apply that to trading. I wonder if they could apply those same principles, which makes you successful, Captain Shane, to trading, right? They know that they will execute the plan no matter what.
Chris, I think you're onto something.
I'm just a random guy on the internet. I don't know what I'm talking about. Imagine that you're a lawnmower, okay? Or let me put it this way. I'm bougie. I don't mow my own yard. Imagine that the lawnmower shows up to my house, okay? And he gets distracted by that squirrel, and he only mows half your lawn, right? You're not going to be very happy about that. You're certainly not going to pay him, the full rate because, dude, you didn't finish the job, right? So, of course, he's going to finish the plan because that was the point of the plan. I'm going to get paid for this job. I'm going to make sure I finish the job. Or imagine a brain surgeon. Do you think he would FOMO into cutting different pieces of the brain out just because he's there? Bro, I've never seen one of these before. Let me just cut that out real quick. And then he's like showing all his friends, dude, did you see this? This is so cool, right? I just couldn't help myself. I had to do it. Just had to. All my friends were talking about that one piece of brain, and I finally saw it. I finally got some. Of course not. You got to treat trading like a professional. who knows exactly what he or she will do in all situations. All situations. But I will be 100% honest with you. And Shane, I imagine this is the case with you. There have been situations that were not covered in the SOGs, SOPs, and you're like, oh, wait a minute. We need to add that to the plan. Am I right?
Yeah, it's sometimes that happens.
For sure. And especially if you're newer in the market, something is going to happen where you're like, whoo, I did not expect that. That is certainly not bad luck. That is a flaw in my plan because I did not expect that to happen, right? Kind of like freaking healthcare can report whatever they want anytime they want and totally kneecap your trades. Guess what I do in that situation? I don't trade those anymore. And now they can't hurt me. That is part of my rule set that I developed because of realizing, well, this is a huge risk that I am not going to allow ever to come after me. Golden toilet tweets is a great example. Now, until we can get like an alert, right? Imagine how cool, what a great app this would be. Every time that Trump pulls up his phone, it just alerts everybody. Golden toilet tweet inbound, right? That would be a sick app. You could make billions of dollars with that app. But until that happens, we just got to roll with it. Selling options as income. Ooh. You guys know this is one of my biggest, ugliest, nastiest mistakes. Because it happened to me. Rick, why do you think that selling options as income is a mistake?
Well, it breaks the golden rule of leverage, doesn't it? Where you stand to lose more from the trade than you could gain. But also you can get really sucked in by the promise of it as it's going to pay you an income, and that 80% win rate or whatever it is, that really high percentage win rate will feel really good. You're unlikely to lose on the first trade, so you may get a spell of trades that you win in a row, and then you'd be absolutely hooked on it. But over the long run, if you've got negative expectancy, then you're just going to be bleeding money.
Exactly. And people treat selling options as an income source. And that is a very, very dangerous way to treat the market, because the market will do whatever the market's going to do. And if dude, imagine, Rick, you go to work, right? And let's just use round numbers here. Let's say that every week you go to work, you make $1,000, right? 1,000 freedom bucks, by the way. And the most powerful currency in the world, by the way. Now, imagine that you're getting 1,000 of the most powerful, most freedomist currency bucks in the world. And your boss one week is like, no, Rick, sorry, dude, I need you to give me $15,000 back. Is that really income? No.
That wouldn't be good, would it? You'd quit that job pretty quickly, I think, hopefully.
That is what it's like to sell options as income. You collect the money, you collect the money, you collect the money, and then one day they come collect 6, 8, 12x as much back from you. I mean, really think about it as if it were a job, right? You go to fire school, you do all this work, you're saving all these babies, you're kissing all these women. It's like, you saved my baby. Come here, baby. I'm gonna give you a big old kiss, right? I'm sure things like that happen all the time. And you're all in the calendars that come out once a year with wearing nothing but like the suspenders and the big old fireman pants, right? I don't know what you do in your free time, Shane. I'm not judging, but
I'm Mr. January.
You're Mr. January. Very cool. Oh man, I can't wait to see that. That's January right now. I can't wait to see it. But dude, you go through all this effort and you're making your money, $1,000 a week. Everything is good. And then you're the captain. Who's above captain? Is there anybody above captain?
Yeah, there's assistant chiefs and then fire chief.
There you go.
The big dog.
Fire chief walks in one day. He's like, Shane, you're doing great, but I need all of the earnings you made last month and half of the earnings you made the month before back. Is that cool? You good with that, Shane?
Absolutely not.
No, of course not. Yet people want to treat the market like that. Oh, I'm cool. And it's so great. Rick, you're so smart, dude. We're going to pay you every single week. And then we're just going to collect all of it back all at once. It's just a losing proposition. Right? Under no circumstances, first off, are you ever allowed to sell options. Whomever is watching this, whenever you're watching this, you are never allowed to sell options. The expectancy in many instances is negative because of the risk and return. The expectancy is what we're after here. Do we have positive expectancy? Given enough occurrences, do we expect to have more money in our account or less? And if you need income, go get a job. I hate to say it, but it's the truth. If you need income, go get a job.
Hey, my fire department's hiring, just so everybody knows.
You have to go to fire school for that job?
Yes.
Oh man. Dude, I really admire what you do because like I am so squeamish. Like I can barely take care of my kids' boo-boos, right? And you go in there and you take care of the business. And I don't want to hear any stories, my friend, but I'm sure you have lots of stories. And yeah, oh man. I really admire what you guys do. So the market's super unpredictable, and it can go months in between giving you setups for your strategies. Okay? But a lot of people take that as in, I got to do something, right? You're looking for income, but that can cause you to take subpar and not planned out trades because you got to get that income, bro. How am I going to pay my mortgage this month if I don't go get my income? Well, you go get a damn job. Just a fact. Don't take it personal. It's not anything against you, but if you need the income, go get a job. All right, let's keep going here. Not journaling your trades. Kostya, thank you for coming to class today, my friend. Kostya and I were hanging out together a couple nights ago on Discord. It was great. Kostya,
yeah.
Why would this be one of the biggest mistakes, not journaling your trades?
Oh, excuse me, Chris, your reception's getting really bad.
Are you serious?
What?
Are you messing with me right now, Kostya? Bro, I will ban you faster than you can say Kostya. You ready for that? No, I'm good. I'm just joking.
Yeah. That's a good question. I'm guilty of not doing a good job, not journaling or journaling. So very guilty of that. It seems like it's a lot of work. The good thing is it's just the beginning of the year and we haven't had too many trades. But I do like the idea of knowing the reasons of why we got in and get out of the trades. Mostly why we got out, just to look back and see the pattern. But it also keeps you honest about, or it keeps you more honest about your rules, whether you want to, when to get in and when to get out. So I think that's probably the biggest win, at least for me.
Oh yeah, that makes total sense. So I want to, and Shane, I appreciate you volunteering, and so we can keep coming back to this. But like, imagine that Shane went to fire school, but they never wrote down any of the stuff that put out fires. They didn't journal what worked. I think that would be a bit of a problem, don't you think, Shane?
Yeah, big thing with that is EMS. Like any medical call you go on, we got to journal it just to see if what we're doing actually helps the patient out.
Mm.
But like, to that point, in the past, somebody was smart enough to say, we should write down what is working. We should write down what didn't work. That way we can learn from it. Right. And so you as a trader, you as an investor, you have unlimited opportunities to do whatever the heck you want in the market. And in fact, journaling will help you decide what those unlimited opportunities should be narrowed down to. Lucky Chevy had to go. I couldn't not say this. If you don't journal, it might cost you. I couldn't avoid it. It was so good. It was so good. That's what you get for trying to act like you didn't hear me, my friend. That's what you get.
Thanks.
So, Kostya, how are you going to know if your plan is working? How are you going to know?
I look at my bank account at the moment, and is it going up or is it going down?
There you go. Exactly. I just look at the bank account. If it's working, I'm going up. If it's not working, it's going down. That should be easy enough, right? Yeah.
Yeah, no, but that's exactly why you should do it, right? So what I noticed, I think last summer, one of the things you were saying is I noticed when the fear and greed went above a certain point, it tended to pull back. So you journaled your trades and you noticed that pattern, and you wouldn't have done that if you just kind of nilly-willy get in, get out, get in, get out. So I think it kind of you paying yourself forward, right?
Oh,
Even
yeah.
though it might seem like it's a tedious work, you really you're paying yourself forward for the information that you'd be hard to get in the future.
Right. Makes sense. It's going to help you know if your plan's working, and it's also going to help you track areas where you can improve, right? And this is a defining feature of successful investors. Not just investors, but really all professions. Every profession since the beginning of time, they wrote down what worked, they wrote down what didn't work, they did more of what worked and did less of what didn't work. And then eventually, the best people in that, whatever it was, the best people in that space shared that knowledge with other people so they could be successful in that space. So this is how you share with yourself, hey, this is working, this is what isn't working. Document what works, what doesn't, and adapt the plan, because this is the important part, adapt the plan to your personality and your portfolio. All right. We're back to Charlotte. Why do you think FOMO and panic selling are so bad?
I guess because you just jump in without analyzing and making sure it meets all your entry rules beforehand.
That's probably the best answer ever. Yeah. Without any sort of regard to the rules, because most people don't even have rules. You just get in and you get out based on whatever you feel on that day. Maybe sometimes you're terrified that a stock is crashing to lows not seen since yesterday. Oh my gosh. If this stock didn't go up 3% today, it actually went down to the same price that it was yesterday at 2 p.m. This is unacceptable. Right? And so they'll panic. Or FOMO. Oh, snap. I heard silver's going up. I got to go buy some silver. These are human behaviors that you have to break. This is human nature, and that's why it's hard. This is what causes the 90-90-90. This exact thing, FOMO and panic selling, is exactly what gets you to 90-90-90. But you can take advantage of this with Outlier. You can take advantage of the FOMO and panic selling. Not a sales pitch, but in this is what we do. We buy stocks as they're getting more greedy in the greediest sectors, as the market is getting increasing its greediness. That's what we're after. We want to be a part of this fear and greed move, right? But we also want to get out of the way before that fear starts to come in and all the greed turns around, right? Get out before everybody else has a chance. That is what Outlier is after. We want to be as greedy as possible when everything is clicking. And then when it stops clicking, you just get out of the way before everybody else does. No risk management. Stocky Locky. What do I mean by saying that's one of the biggest mistakes? No risk management.
You've got no risk management. You've got no control over your account.
So
we can go in super heavy on a trade. We can hold on to the trades. We can go either end of the spectrum, and it can be a complete disaster without any risk management.
That's a great answer.
Consistency as well. There's no consistency with what you're doing.
Right. Yeah. Well, what about this, right? Stocky Locky. Why would I even take the trade if there's a chance I'll lose? I'm only going to take the trades that win. Right? I can do that, right?
I wish that was the case. Nancy Pelosi would.
Nancy Pelosi would. Chris Chains, he never loses. He only takes the trades that are going to work. Nobody else has that.
No losses.
Because I know exactly what's going to happen in the market, right? I don't need risk management because I know what's going to happen, right? I'm one of those YouTubers who predicts the future, and you got to listen to what I'm saying, right? Because I'm such a genius, right? Stocky Locky, I know what's going to happen in the future. So what do you need risk management for?
Oh, you don't in that case.
Nah, of course
crack
not.
On. Just...
Crack on. I love it. And of course, the stock should go to my target. So I'm not going to worry about any sort of stop loss. It just should do what I tell it to do, right?
Definitely should, yeah.
Yeah. Right. But professionals understand that this is not really the truth, right? The most important part of the plan is planning on the plan not going to plan. That is how you will survive, is making sure you have a plan when it doesn't go to your target, because you don't know what's going to happen next. And there's every likelihood that this one individual trade could end up being a loser. It's crazy, right? You change your perspective and start acting like a professional, and then you see what it takes to be successful.
What you do, Chris, you see your win rate being less than 50%, but you're still being profitable.
Yeah. You don't have to have 100%.
That's the thing that blew my mind when I first joined Outlier.
You don't need a high win rate. Does it help? Yeah, it makes life a lot easier. But you have to build the losses into the plan for the plan to even work. Revenge trading. Shane, we've already talked to you too much. We're going to keep going. William, Mr. Skinny. He's so skinny and he's so buff. Even though he's been gone from the gym from 6 months, that when he walks in the gym the next time, they're going like, dang, look at that dude. He's so skinny and buff.
That's right.
What does revenge trading mean to you?
Yeah, I've done this. I probably think all of us have done this. You know, when you lose money on something, it's hard to take that loss and stomach it. And you want to make that back immediately. You're not willing to be patient for it. So either you buy the same stock again, double up, buy the dip, and then you only need to move half as much to get all of your gains again, because now you have twice the position size. And when it drops again, you know what? Let's double up again, because it's got to go back up. It can't go down forever. Yeah, we've all done this. I've actually been guilty of this once or twice, and it's never really a winning formula. It's pretty rare that it'll actually work out in your favor. So that's the beauty of Outlier. We get away from those bad habits.
No, well, what you're talking about though is very real, right? That stock stole my money. That stock owes me money, right? I'm going to double up to make it back that much faster. Exactly what you said, right? I hate this stock. I'll show it who's in charge. I literally watched a guy who I don't follow anymore, but this was when Tesla was going meteoric several years ago. Like, it only went up. And he's like, that's enough of that. I'm going to start buying puts on Tesla. Like, who do you think you are? Do you think you're Warren Buffett and that your account's so big that the only thing that's going to happen is it go down because you told it to? Of course not. What a stupid thing to do, right? Now, I don't know what happened in that trade, but I can only imagine it didn't work out well for him. So good luck with that, my friends. Good luck with that. Ooh, this is a toughie. Art. Why is having the right strategy at the wrong time a mistake?
VKTX.
Now, what do you mean by that?
Nothing at all. We had a great strategy, but it was a black swan event, or it was something in the news, and it tanked on us. But it still was the right strategy.
Mm-hmm.
It's just that it didn't go our way, and we had no idea that was going to happen. And that's it's just part of the game. So you gotta build it into your plan, and Trump is our worst enemy sometimes in the market. He'll send something out, and we'll be in something that's working great. We have the right strategy, but it's the wrong time because the news comes out, and it's a little black swan event, and it messes us all up. So
yeah, or it helps. We've seen that plenty of times too. But the right strategy at the wrong time, right? Markets only trend 40% of the time. That is the old adage. I don't know if you guys have heard it, but this is something that I heard. I had somebody tell me the other day they ran some back tests on Plan M, and they were like, you're only in Plan M 34% of the time. And I was like, sounds about right. I'm good with that. There are so many times where you should not be trading. So many times where the only thing to do is sit in cash, don't F up. Right? But you feel the urge. I got to do something. I can't just sit here, right? I can't call myself a trader if I'm not trading. This is a real thing. This is a real thing. Or your family telling you that. Or your friends telling you that. Or social media people telling you that. Well, if you're just sitting in cash, you're obviously not a trader. You don't know what you're talking about, right? That's a real thing. And a lot of people get a lot of pressure from that. But you have to focus in on your plan. And this is your plan. You understand how that plan works. It's designed to work in certain market conditions. And the other conditions, you get out of the way. You let it do what it's going to do. You don't care. And you're just going to sit and you wait as what Mark said earlier. Well, actually, I don't think I have that slide right here. Yeah. You wait in cash. How long? As long as it takes. There's no reason to rush into anything. You should never, ever feel pressure to take a trade. Let's see who's the next victim. Let's see who's paying attention. Mark, you there?
I'm here.
Why would you say trading on fundamentals is a mistake?
And it goes back to trading what's in front of you, like not what should be. If you're looking at, oh, this is the price to earnings and this is your price to sales and it should do this and these are EPS and this is the EBITDA and all that crap. Like it doesn't matter. Like the market doesn't care, about what the numbers on the nice little chart is and all that. It matters what the people in the market are doing, and you need to react to that, and not what theoretically should be happening. So
right.
If you focus on it's focusing on the wrong thing.
I agree with you, dude. Focusing on the wrong thing. But listen, if you want to focus on that, go for it. Right? Mark, I'm not going to tell you that you can't go look at free cash flows or earnings to sales and earnings per share. If that's what you want to do, go for it. Right? But you're not going to make a single dime because of it. Just because those numbers are happening. Just because the same store sales grew at 17% year over year doesn't mean you're going to make any money at all whatsoever. But they can help you build up that story if you really care about that. If you actually really care about that, by all means, add it to your plan. If you love the story, go for it. Just remember that profits follow price, and price alone pays. I can say that. I'm not going to get any cease and desist orders there. Price alone pays because profits follow price. And it doesn't matter what your fundamentals say. Price alone pays because profits follow price. Eat that, Brian Shannon. Let's keep going. I'm not bitter. You're bitter. Rick is the most bitter of us all because he's been ignoring the Greeks. He's been making this mistake over and over and over. Right, Rick?
No. Yes, maybe.
Why would this be a mistake, man?
Well, I think you said when you first opened an option chain, you were presented with this big grid of numbers, and you were like, I don't know what I'm doing here. Which one do I buy? I just want to make money.
Yeah,
and I think a lot of people buy either at the money options or out of the money options or the zero DT options because they see it on Reddit. These people making massive amounts of money overnight, and they don't really know what they're doing. They don't understand how it all works, how it's going to decay, and how they're not getting any intrinsic value from the trade. They just want to make money, and they just copy somebody else and buy into it without really understanding what it is that they're buying. They're actually trading time rather than a leveraged investment, for example. So I think you really need to understand what it is that you're buying, and really you have to have some sort of understanding of the Greeks. You don't need to know. You don't need to memorize the Black-Scholes model or have it tattooed on your thigh or something. But an understanding of roughly what's going on, I think, is otherwise you shouldn't be trading options.
I agree. There's a lot to learn with trading options, and the Greeks are part of that, right? Make sure you understand the uses of the Greeks, right? How many deltas do you have, for example? How much gamma exposure is increasing? These are the kind of things you got to ask yourself, but you don't need to memorize the Black-Scholes model. There's no reason to do that. Not at all. You just need to understand how to make money. That is what you need, right? Now, adding complexity for no reason. I'll take this one on. When it comes to options, there are 4 possible ways you can do it. You can buy a call, sell a call. You can buy a put or sell a put. Everything else is a combination of those four possible, I don't want to say options, but those four possible options. That's it. Now, because of that, people get really fancy with it. I've tried to get really fancy with it. I tried to invent my own trade. And I spent hours and hours and days trying to figure out what sort of combination I could get with calls and puts where I could end up with like as little risk as possible, maybe even no risk, a risk-free trade. Wouldn't that be the coolest, sickest thing ever? Trust me, if you think that you have figured this out, somebody has figured that out ages ago and made sure that there's no possible way for you to do that. All right, there's no free lunch in trading. But adding complexity for no reason. When I trade, I like to buy one deep in the money option. That's it, right? Obviously, contract size will differ, but I'm just buying one leg, one deep in the money option. That's it. Now, of course, I don't just buy one contract. What I'm trying to say here is that there's one leg. It's not complex at all. It is, I want to go long this stock. This is how I'm going to do it. Yeah, you could do a jade lizard. You could do all kinds of zebras. You could do iron condors, iron butterflies, straddles, strangles. There's so many different types of option trades you can make. But you don't need to. You really don't need to. In fact, we watched this video. We're not going to watch the entire video, but I do want to go to the video and I want to show you this real quick. So I'm going to click this. Let's see if this link clicks. No, of course it doesn't. Why would that link work like I told it to? There we go. So we don't need audio for this, so we're good. The video that I came across, this guy was talking about how he created a risk-free trade, the SPX 0DTE risk-free profit forest. Risk-free. It sounds so cool, right? Oh my good gravy. I cannot wait to go skipping through the woods of the risk-free profit forest. Man, could you imagine Little Red Riding Hood and I were skipping hand in hand, arm in arm. She's got her basket. She's taking over to grandma's house. Yeah, exactly, Mark. We're just doing our thing. And we got the risk-free profit forest, baby. Right? Hansel and Gretel are running away from the witch over there. They're like, we're in the wrong forest. Sorry. And they keep on going. But me and Little Red Riding Hood, we're cool. We got risk-free profit forest all day. What he did in this was he took a credit spread. Now, I understand this is difficult to see. I'll even try to make this a little bit bigger. But what he started with was a credit spread, a put credit spread. Let's go to that real quick. Put credit spread. A put credit spread looks like this, where if the price of the stock goes up, you can make some money. If the price of the stock goes down, you can lose a lot more money. But point is that what he figured out was, hey, if these trades work, this is great. If it goes up, this is fantastic. And then instead of just being content with it working, you can go back and watch the video. That's why I put the thumbnail up there so y'all could watch the video. But essentially, he took a spread where he might have made $200 per contract. And then he started adding complexity. So the price is right here. And he's like, listen, I've already made money in this trade, but I don't want as much money as I had before. What I'm now going to do is I'm going to buy some other options with it. So I'm going to set up this little thing over here, and I'm going to set up this little thing over here. So rather than like actually making, let's say, for example, $200, I'm going to spend $110 on all this other baloney just in case it happens to come over here. Then I'll make more dollars. He added a ton of complexity. And by doing so, he took his profitability and cut it by less than half. But in the off chance that it happens to go down, he just might make a little bit more. So I don't want you guys trying to do anything like that, right? Have a plan, stick with the plan, and don't add complexity to the plan. The stock market's hard enough already. You don't have to add complexity to make it even harder. You know what I mean? So this was a big lesson today. Mark's cat is so impatient. She's like, give me some food now. You're the cookie monster. You know where all the cookies are, right? So thank you guys so much for coming to class today. I hope this was useful. You don't have any homework this weekend. We're going to be wrapping up in the next couple of weeks, but next Thursday, I'm very excited. We're going to have Lex from Tradier come in like teach us all the other good stuff about options, which I'm very excited about because Lex actually likes to sell options. Now, I'm not going to get into a debate with Lex. I'm going to let him tell me everything I did wrong with my itty bitty baby brain. That's just where it's going to be. This is not a debate. I'm actually excited to learn from Lex because clearly I'm the stupidest person to ever sell options. And he must be much more smarter than I am because he wouldn't say much more smarter, right? Hey, if somebody were looking to save time, make money, and start winning with less risk, what do you think that they should do? Oh, click one of those 2 videos that's popping up right now and do the finger dance. Outstanding. You guys are awesome. Thanks so much for coming. All right, you guys have a great day. Thanks for coming to class. We'll talk soon.